Well, welcome to the taxation part of charitable gifting. Again, we don't expect you to do the taxation. There's usually specialists in the taxation field that specialize in this. In many cases, it's done by the charities themselves. I know several times I had clients who came up with really weird things they wanted to do with charities. So I contacted the Red Cross, and the other one was the Boy Scouts. And they actually did all of the taxation for them. In fact, they filled out the whole tax return for them for the year, no charge because of the donations they made. So again, what this is primarily so that you have the information to discuss generalities with your clients, and also tell them some things that are smart to do and not smart to do. As we had in the last module, we covered items that probably do not make a lot of sense to gift from a tax standpoint. Again, if you want to do it from a charitable standpoint, that's something else. But if you're talking about taxes, there are limitations we had in the last module. And in this module, we'll have the same type of situation. So let's take a look at it. Our objectives: describe the various taxes associated with gifting to a qualified charity. And we're talking about federal taxes, not state. State taxes are different, and we don't go into those. Describe the items that charities must include in their tax returns. And that's for the charities, not for you as your clients. Discuss the items that require appraisals in their threshold. And finally, discuss the adjusted income caps for various gifts to the various types of charities, which is probably the most concern to your client. I covered the one that charities must include in their tax returns because that is a good information for you, and your fiduciary responsibility is to check out the charity's tax return. And it really doesn't take long. Although they're 50 pages, 60 pages, even 100 pages at times, there's just certain parts of it that you want to look at to see where they spend the money, and how it's spent, and who gets the money. Gift and estate tax charitable deduction. Deduction for gift and estate taxation is fairly straightforward. Federal, state, and local government entities do have taxation on it. Depending on your state, there's a state estate tax. There's also state gift tax in some entities. Those of you in California, we do not, for some reason, have a state estate tax. And federal estate tax is indexed at roughly $5 million. We have deductions for charitable organizations, and charitable organizations, some cases, also have to pay taxes. For example, if you're a fraternal organization, which is mentioned next, property is used for charitable purposes, it's exempt, but you're going to have, for example, a bar at the American Legion, or bingo party at a church. That's different. And then veteran organizations, which is where I've dealt with, again, special rules, and we'll cover those that are special that you need. The due date of tax returns. Gift tax return is filed as an attachment to the income tax return, and thus is due by the 15th day of the 4th month following the end of the calendar year. For charities, they have the year as their fiscal year. Estate tax return is due 9 months after death of the estate tax meets the tax threshold of $5 million indexed, and that applies to individuals. I might note that the gift tax also applies to individuals, not just for purposes of gifting, but for any types of gifts you make. And it's attachment to the income tax return. So the payments are due by April 15th, but you have till October 15th of the year to actually submit the tax return. And there's a big advantage to overstate, because if you overstate the needs in April and pay higher, you get a refund when it comes in, and you look like a hero to your client. If you do the opposite, which many people do, is guess low in April, then later on you pay taxes and penalties and interest, and then your client really gets mad at you. So I always overestimate the taxes in April, pay a higher amount, and make sure they get some back. Gifting restrictions. Charitable deduction is not limited to gifts for use within the United States if made to a qualified charity without restriction. That's the key. It's got to be on the charitable gift list, and there cannot be any restrictions. And the one I can think of is the Haiti Relief Fund, and that's it. Now, for the Irish sweepstakes is not a charitable deduction, and I remember many my earlier tax days, I had many clients buy them, and that was before we had lottery tickets in the United States, and they thought they were deductible. They're not. It's got to be listed on the qualified charitable list. Split interest gifts involving a charity and non-charity are not deductible unless it's a qualified type, and as a CRAD is probably by far the most common type. Tax forms used by the charities. And now we're talking about the charities have. Charity returns are due 15th day of the 5th month following the end of the organization's accounting period, which is generally year-end. Dependent charity. Form 990F for public charities. Form 990PF for private charities, or foundations is another name for private charities. If the charity's gross receipts are below $200,000, assets are below $500,000, we have an easy form to fill out. Of course, there aren't that many charities that fall on that. Those would be really local charities, not national, obviously. Church, political organization, any organization with gross receipts of $50,000 or less, filed for 990N in lieu of the above forms. And returns are as complex as CLU's form was 55 pages in 2013. So it's not something simple to fill out. You're going to have an accountant do it. If you try doing it yourself, I know my son-in-law has a youth soccer team that's a not-for-profit, and he's done a lot of taxes in life, and he got all screwed up when he tried doing the one for the 503. So even though it's was a 990 EZ, it was not that simple. You need to bring in someone who knows taxes. Included on the tax form, besides the normal finances that's associated with any tax form, the Form 90 addresses its governance, the policies and documents, such as you need a conflict of interest policy, you need a document retention policy, you need insurance policies listed, you need a code of ethics. This is part of the tax return, believe it or not. And certainly when you're helping start a charity, which I know Financial Planner has been involved with, which we talked a little bit about in the previous modules, you also have to have this done before you really start charity and apply for the charitable exemption so that you can do the tax return when it comes up. Because quite honestly, once the charity is formed, people seem to lose interest in helping. Documents required with the donor tax return. This is for your client, not for the charities. Contribution of $250 or more require written acknowledgement from the charity. So if I give $200 to my church with check receipts, that's good. But if I had $250, I need something from the church acknowledging it. The same way with the Blue Cross, Red Cross. If you're giving to United Crusade through work, your pay stub will show some acknowledgement for you. But if it's over $250, there should be a letter from United Crusade thanking you for the gift. If anything received by the donor when gifting is worth over $75, the donee must provide how much is deductible for income tax, estimate of the fair market value of the goods or services donor received that you gave to them, or your client gave them, and the status of property that will not be used for its exempt purposes. Now that means you have to get together with the charity and find out what they're using the assets for. So I know a few years ago I had a business and I sold off the business. I had 6 regular computers and a couple of laptops which I gave to a charity, and which they needed. The software was up to date, etc. But I had to get the estimate from the donor, from the appraiser. I also had to get a status of how they were going to use those. And again, I knew they weren't going to be used as part of the charity, which had impact on the amount that I get a deduction. Qualified appraisals, appraisal for any contribution property worth $5,000 or more, unless it's a publicly traded stock of $10,000 or less. Vehicles used by charity are deductible, or deduction is limited to the gross proceeds of sale by the charity. We mentioned in Module 2 also about the intellectual property, marketable securities, inventory and other property donated by a corporation for the care of ill, needy, or infants, and stock and trade inventory property primarily for sale in ordinary course of business. So these are the ones exempt, and what I found was kind of interesting is property donated for care of ill, needy, or the infants. That can be a very broad classification. Taxpayer deduction for donations to charity. You must itemize your deductions, so you can't use a standard deduction today. We had a couple of years where you could get a charitable deduction without itemizing, but that period is past. You include the deductions on Schedule A, and there's some restrictions. First of all, you have a limitation based on the percentage of the taxpayer's AGI, adjusted gross income, which we'll be discussing shortly. By the type of charitable organization, be it private or public, and the type of property donated, use-related or non-use-related, and its used by the charity. Again, you have to get the information from the charities to really do a tax return. This is small print because it's the best I could do, but again, we're not trying to make you experts on it, but you should be aware. The 50% charities and the 30%, the 50% charity column, which is column 2, are public charities. The private charities are 30%, which are foundations. Cash or cash equivalent is up to 50% of AGI. You can take in a yearly for tax deduction. 30% if it's to a foundation. Ordinary income or short-term capital gain is the cost basis up to 50% or up to 30%. Long-term capital gain is up to 30% of AGI or cost basis to 50%. So whatever's more favorable, the fair market value of the cost basis is what you use, and that determines how much you have. Then we have the cost basis to 20% for foundations. It's less favorable. If we have qualified stock for foundations, the fair market value up to 20% of AGI. And for tangible personal property long-term holding, we have use-related, the same as the long-term capital gain above, and not use-related, the cost basis is the 50% of AGI. If it's a foundation, use or not use is related basis to 20% of AGI. Now, you should be aware of these differences because it makes a difference of what you give, who you give, etc. And the only reason I really put this on here is because I want you to think about when you're dealing with your clients. Restrictions: if there's 50% property max, gifting is a 50% deduction. In other words, if I have AGI 100,000 and I give gifts over 50,000, give 50,000 is the maximum give. If there's no 50% property being used, then the 30% is the maximum. And if there's no 50 or 30%, then the 20 is the maximum deduction. So the type of property determines what the deduction is. Restriction on the previous slide did not mean the deduction is lost if exceed the cap. The deduction can be carried forward for 5 tax years, but retains the 30, 50, and 20% characteristics, so it can become very complex. And again, you need somebody who's a tax preparer to do this for you. Also, you must keep the records so that you can track it. I know a lot of clients do not like to keep records. They have to keep records in this area, however. Summary. In this module, we covered that charities are required to file tax returns with attachments covering various aspects of their mission, not just their finances. Taxpayers have caps on the amount of charitable gifting they can make in a year for income tax. Taxpayers must itemize to take the charitable deduction, and finally, tax deduction depend on the type of charity, type of gift, and use of the gift by the charity. And again, we don't expect you to do the tax forms, but you should be aware of it and be able to work with the client as to what's the best type of thing to give to charity, and realize the costs associated with the appraisals.